Right. Morning, everybody. I think we're at 10 o'clock. So I'll go ahead and call the State Board of Finance to order. First thing on the agenda will be review and approval of the minutes from the previous meetings. Are there any edits? It's just one set from the February 10th. If there are no edits, take a motion to approve. Is there a second? Motion's been made and seconded to approve the minutes. All those in favor say aye. Aye. All those opposed, no. Minutes are adopted. And with that, I'm going to pitch it to the treasurer for the treasurer's report.
All right, thank you. The portfolio delivered a strong third quarter, well within the target rate of return, and nearly 96 million in quarterly income. The portfolio structure continues to provide flexibility, with principal rolling off systematically to enable more than 2.1 billion to be reinvested into higher yielding long-term securities over the past 7 quarters. The portfolio has remained resilient and well positioned to manage the geopolitical and interest rate risks. So at this time, I'll turn it over. Steve, I think are you up? Oh, sorry. Yeah, Steve.
Okay. Going with slide 2 then on our presentation, we have illustrated portfolio yields over the past 3 months, which show a stable flow of income month by month, both from short-term and long-term investment categories. The next page, we have income for the 3 months added together, producing a total net income of approximately, well,
Yeah. Susanna, can you hear us?
Now I can, Jim.
Your mic wasn't turned on earlier.
Gone again. Now you're back.
Technology makes us so much more efficient.
mm-hmm.
Well, I want to hear those great results.
They're good results. We're getting some of the iPads logged back on. So just give us a second.
Thank you. Thank you.
Chad, did you get online?
Yeah, I'm offline also.
You on, Chad? I know it. Password is password. Dr. Milligan, are you online? Is your, okay. Hey. Hi, Jason. Do you have the internet password? Which one is it? Can you come and get it on? Doctor. Which one is it? It's hidden. It's pointed towards. So yeah, you can't pick it. You can do them next. I can manage with paper. Bring my binder. Always bring my binder.
So we're not connected.
No. I think iPads are better. We just need to figure out what the deal is. Yeah. Waste. But I like my binder. And I hate for y'all to do all that work. You in, Mary? Good. They get you? Yeah. I'm fine. Do you mind helping Jason and see, did you get it? Need some help with it. Numbers are that good. Positive energy I've got. Hey. Well, I sure hope you enjoy that Subway then. Subway's about one of the most expensive lunches in town these days. Okay. Treasury's not up. I'm not on, but I'm. Yeah, we got the screen in front of us, so. Okay,
Okay,
why don't we take it from the top there?
sir. Well, we begin our presentation then on slide 2, which is an illustration of net income by month. Portfolio yields over the past 3 months show a stable flow of income month by month from both short-term and long-term investment categories. Slide 3, going to the next slide, has income for the 3 months added together, producing total net income of approximately $96 million for the quarter. The first 2 columns have accrual basis and then ledger basis book values by category. The next 2 columns have accrual basis and then ledger basis income figures. Those are divided by type of investment. The next presentation there has a pie chart showing the division of assets by category, broad categories, with 56% of assets in mortgage and loan-backed securities, 19% in corporate bonds, then we have 13%, 19% in various kinds of government bonds and 13% in corporate bonds. Going to the next slide, we have portfolio returns by quarter. The trend in net income by quarter shows considerable stability, as average quarterly income was 99.5 million quarterly in the prior fiscal year and is 97.6 million quarterly so far in fiscal year 2026. On that same slide, the next section shows total return at 5.1% over the past 4 quarters or 12 months. That being the sum of price and income returns. Below that is shown the annual trend in income, with net income rising to 398 million last fiscal year and already approaching 293 million 3 quarters into the current fiscal year. The next slide shows the trend in interest rates over time, as yields for their portfolio roughly follow the trend in yields for U.S. Treasury and other high-quality bonds. So in that chart, the purple line represents Arkansas book returns, and the others are various categories of U.S. Treasury yields. The next slide has some compliance data showing the at the top the distribution of ratings for corporate securities as divided between commercial paper, that is short-term investments, and corporate bonds. The ratings levels shown are in compliance with policy limitations in terms of Standard & Poor's, Moody's, and other equivalent ratings. Durations for the portfolio are concentrated in the 1 year or less and in the 3 to 5 year duration bands as shown at the bottom. On the last page, we have the mix of assets under management at quarter end. The Treasury general portfolio is on the left side, followed by money management and various smaller investment pools. I'll turn it over to Steve Pulley and Robert Ramanak for other summary and forward-looking comments.
Thank you, Steve. And Mr. Chairman, as Treasurer Thurston mentioned earlier, the third quarter closed with a solid portfolio performance as we had a return of 346, and that is well within the guidelines we projected 3.4 to 3.5. The return generated nearly 96 million in income for the quarter, which cumulatively that amounts to almost $293 million for the fiscal year so far. These results remained aligned with our objectives of preserving the principal, sustaining liquidity, and delivering stable income. The portfolio is structured to systematically return principal, whereby roughly 10% of the portfolio rolls off in principal each year, giving us the flexibility to either meet liquidity needs or to reinvest into the long-term portfolio. Over the past 7 quarters, we've put back $2.1 billion into the long-term portfolio, and those investments have yielded almost 5%. So it's headed in the right direction. The total size of the portfolio remains steady at $11.3 billion. The long-term portfolio has a value of $9.8 billion, returning at 334. The Fed's 325 basis point rate cuts are flowing through to the short-term liquidity portion and our money management trust funds. The short-term balances are about $1.3 billion, earning a 373, and the money management trust fund is earning 367 on about $635 million. We continue to monitor, both of those are basically affected by the reset in short-term rates. We're continuing to monitoring the cash flow and the forward rate path, so reinvestments are impactful as market opportunities arise. Despite the ongoing bond market uncertainty, the portfolio continues to show resilience, and we remain focused on managing geopolitical and interest rate risk while positioning for the future. And with that, I'll open it up to get any questions about the portfolio itself.
Any questions on portfolio performance?
If there are no questions, I'll turn over to Robert Romanek, who's going to give us the macro overview and also a projection of what the benchmark will be for Q4.
Morning, Chair Hudson, Treasurer Thurston, and members of the board. With your consent, I will be setting the new target rate of book return for the fourth quarter of fiscal year 26. Conflict in the Middle East has created an elevated level of global economic uncertainty. As expected, Federal Reserve Committee members opted to hold the Fed funds rate steady when they met at their scheduled meeting on April 29th. This brings the cumulative reduction in short-term rates to 175 basis points and leaves the Fed funds target range at 3.5 to 3.75%. It's still too early for the Federal Reserve officials to assess how the war in Iran has affected the two sides of their dual mandate, given the horizontal progress in U.S.-Iran peace negotiations. This was underscored at April's FOMC meeting, where diverging views on the future path of monetary policy were evidenced by 4 dissenting votes and a push for a more symmetrical or balanced outlook between lower and higher interest rates. Financial markets are still looking for a reasonably quick cessation in hostilities with Iran, which would allow incoming Fed Chair Kevin Warsh to resume his preference for an accommodative monetary posture and lower long-term interest rates. The forward interest rate curve conveys the likelihood of a prolonged Fed pause, overshadowed by the unstable geopolitical climate. This should pin interest rates in a higher for longer range until a credible ceasefire in the Middle East can be reached. We are therefore proposing to leave the target rate of book return unchanged for the April through June period, maintaining a fourth quarter range of 3.4 to 3.5%. Thank you, Chairman Hudson.
Thank you, Mr. Rowan. Quick question for you. Given the discounting of interest rates coming down and probably being steady for a foreseeable future, is that changing the strategy on the portfolio at all in terms of planning for declining rates, versus stable rates, or do we keep the positioning pretty much the same as it is now? That makes sense.
I think one thing that we've done is we've tried to balance the liquidity portion of the portfolio, leaning it out as much as possible so that we can take an opportunistic viewpoint into the long-term portfolio with these pinned higher interest rates. It's actually helped us provide a steady and perhaps even a higher income profile for the portfolio. So sort of squeezing that short-term liquidity portion as much as possible has been our strategic positioning.
Any questions from the members of the board? Our board members online, you have any questions? Sure, don't forget about you. Okay, with that, I'll take a motion to approve the treasurer's report.
I'll make that motion.
Motion by Commissioner Marshall. Is there a second? Got a second from Mr. Bonds. All those in favor say aye. Aye. All those opposed, no. Motion is approved. And with that, I'll take a motion to set the target rate of book return for the April through June quarterly period, maintaining a range of 3.40% to 3.50%. Is there a motion? Got a motion second? Second?
Second.
All those in favor say aye. Aye. Those opposed, no. Motion passes. That will turn to our regular quarterly motions. As chairman of the State Board of Finance, I make a motion to the board that no funds are available for deposit into the State Board of Finance Certificate Deposit Program. Do I have a second to my motion? Second. Thank you. All those in favor say aye. Aye. All those opposed, no. Motion passes. Then as chairman of the State Board of Finance, I make a motion that the board direct the Treasurer of State to purchase warrants for the succeeding quarter, July 1st, 2026 through September 30, 2026, pursuant to Act 1088 of 2013, and to keep reasonable amounts in demand deposit accounts and money markets during the next quarter for the transaction and day-to-day activities. That was second to my motion.
Second.
Second, all those in favor say aye. Aye. All those opposed, no. Motion passes. Next item on the agenda is a loan to the Office of State Technology from Treasurer funds. This is a loan that has already gone through 3 different approvals. So approved by me as CFO of the state, approved by the governor, and has been approved by ALC as well. We're kind of the last stop before the treasurer funds the loan. We have our state's chief information officer here as well, Jay Hartman, for questions about use of proceeds. But in general, one of the things, one of the challenges that we have with our state technology department in terms of its funding stream, it's on a cost recovery basis. And so they don't really have a pool of cash funds in order to make technological advancements. And so they're dependent on, at times, getting loans from state entities. They've gotten them before from the Development Finance Authority. This instead will be coming from state treasurer funds, and it'll be interest-bearing loan as well. They will use the funds for technological improvements, and then they in turn will bill state entities for the cost of services, which in turn will be used to repay the loan. So it's a way for us to be able to fund technology acquisition. Jay, did I do a decent job explaining that? But any questions about that? We've got all the loan documents in there, kind of laying out how we're going to do this. So happy to answer any questions. No, there's already billings that are going to them. They'll just, actually in this case, we have one loan falling off, and this will be a new loan come in. So it'll be kind of a wash more or less for time.
It will be incremental, right?
And the draws?
Yeah, the draw.
Yeah, they'll draw, not all at once. It'll happen over how many months do you think, Jay?
About 10 months.
About 10 months, okay. Other questions? Well, if there are no other questions, we do need a motion to approve. Is there a second? Second. All those in favor say aye. Aye. All those opposed, no. Motion passes and the loan is approved. And with that, we will turn to the SCIP part of the program. So Grant, if you could come forward and join us.
Good morning, Mr. Chairman and members of the board. The first item for the state captive insurance program will be setting the new rates for the 2026-2027 program year. So that would be the chart that's in your tab under the SCIP, item number 6. I do want to kind of start the conversation out with really highlighting one big thing, and that is we have proven the model works. And that is clearly reflected in what you will see as the proposed rates for 2026, 2027. The way we're looking at it this year is by occupancy bucket. So you will see that K through 12, the total insured value has gone up 5% from 2025 to 2026. Our premium amount that we will be collecting from K through 12 is reflective of 11% decrease year over year, which is inclusive of a proposed 11% decrease in their rate. I will put an asterisk here that this is globally looking at K through 12. There are some school districts who have put new buildings online or have had increases in their value. So you would take this new rate, which we're proposing to be 18 cents versus the 21.6 cents of 2025. Obviously, if there's an increase in value, that might not reflect an 11% decrease for that particular school district. Now we move on to the university and colleges. You'll see that we are proposing a 6% decrease in their 2026 rate versus 2025. So they will be at 15.6 cents. And you'll see total insured value is reflective of a 2% increase year over year. And the premium collected would be a 5% decrease. State agencies, there is an increase to their rate over their 2025 rate to 14.2 cents versus 12.2 cents. That is a 13% increase. Again, what you're trying to do globally for all participants is create a norm. So regardless of if you're a K through 12 or state agency, that rate should get kind of levelized and equalized as this program continues to develop. This is part of that effort. So the state agencies were probably a little bit behind the bell curve. So that's why you're seeing that increase. But overall, holistically, there is a 10% reduction in the rate from 2025 to 2026. At the end of the day, that means more money is staying with its participants, i.e. fewer tax dollars are going to be needed for this particular program. So with that, I'd be glad to answer any questions that you have on the rates for 2026, 2027 for property insurance.
Grant, can you just dig in a little bit more on the state agency line? I mean, it's the aggregate premium increase is not super significant, about what 1.4 million looks like. But what were the drivers on that? I mean, did we just price it wrong internally with our facsimile rates that we were computing, or is it the reinsurance market was somehow evaluating it different?
So keep in mind the three different programs that we meshed. This is the first year that there was a true actuarial analysis and driven determination on the rates. There were three different disparate kind of processes. We've brought it into one. That's really what's driving it. It is not the excess carrier markets. Actually, it's a very soft market. So we're getting favorable responses to the program in London and even in some of the domestic excess carriers. This really is the actuarial driven rebalancing of the rate across all the participants.
So you're just getting a better deal before?
Yes, sir.
Probably should have.
Yes, sir.
Actuarial. Well, the overall pricing is good, and I agree with you. It is showing that what we were trying to achieve, we actually are.
Yes, sir. Let's just keep the tornadoes out of the state.
Any other questions from the members of the board? Seeing none, I'll need a motion to approve the SCIP rates for 2026 through 2027 renewal year. Is there a motion? Motion, is there a second? Second. All those in favor say aye. Aye. All those opposed, no. The rates are approved. And with that, we'll turn to the EBD section.
All right, so your first tab should be inclusive of the formulary for March and April, and then a gene and cell therapy. So we will start with the March pharmacy formulary. A lot of what's going on in March is really the maintenance work and just kind of cleaning up some things. And you will see holistically some generics coming in and driving some repricing, which is driving some re-tiering that we're looking at. Let's see. Item 1 is the generic launch and removal of the brand. You'll see the next bucket are oral solution maintenance. They are just lower cost options that are available, and we are moving the formulary to the lowest net cost. The triptan, these are your migraine medications. We did a holistic look of the migraine class in general. There is a lot of movement within that space. So that's where you'll see price erosion going on, re-tiering to equate to that price erosion, and then keeping quantity limits at an appropriate level. Then we'll move to the new to market. So that's starting at line 17. And these are just, we're going to keep not covered until we have additional efficacy or pricing changes that would drive that. Right now, we already are all covering lower cost alternatives. So we don't see a need to add those at this point. And then the alopecia areata, this is items 23 and 24. Keep in mind, this is a autoimmune condition that is driving the hair loss. This is not just me not wanting to go bald. There is a really autoimmune condition that's driving this. That's why we do cover these, and we are just shifting to the lower cost alternative that has the strongest efficacy with that particular drug. I will pause for the march and see if there are any specific questions. All right. All right, going on to April, you will see the first three. We are already covering an all alternative, and we are moving those to not covered. The first one, we really are trying to be very targeted with this particular medical condition, the hereditary angioedema. This just really is a patient-specific type of treatment, and we're just making sure that we have a good, tight control, and therefore reviewing this on appeal. Moving down to items 3 and 4, there's generic price erosion. So we're removing the brand and re-tiering or removing the PA on the generic. Items 5 and 6, we are looking at just quantity limits to ensure appropriate cost-effective dosaging. The item 5 is for pediatric, item 6 is for adult use. Then you'll move to items 7, 8, and 9. We're moving these to not covered. Either 7 and 8 because they are no longer available in the market. And then item 9, similarly, there are other alternatives available for ADHD, so that's a new to market that we're not going to cover at this point. The SGL2 maintenance, again, this is a particular type of drug class to treat type 2 diabetes. We are moving to the lower net cost generic as an entire space there. Then you're going down to items 17 through 20. Again, this is just the generic move to cover the generic and moving from the name brand. I'll pause there and see if there are any questions on April.
Back to line 2 for April. Thyroid medicine.
Yes.
You said it, I missed it, I'm sorry, but so we have about 1,200 people be impacted by the change. What will they be moving to?
So this is an older medication, and the FDA has actually updated its review and approval process. This actually was grandfathered into the FDA process. So until they go through the updated review and approval, we have a great number of alternatives for thyroid that they can shift to. So this would be like levothyroxine, and that's which generally is probably used prior to this one.
Okay. Are there any questions?
Okay.
Hearing none, I'll take a motion to approve the March and April EBD pharmacy formulary recommendations. Is there a motion? Got a motion? Is there a second? Got a second. All those in favor say aye. Aye. Those opposed, no. Motion passes and the list is approved.
Great. Going.
Gene therapy.
Yeah, cell and gene therapy. So again, this is an evolving process that we're looking at. There are a great number of advances in this particular section of medicine, but I would emphasize that medicine is a practice, specifically in this case. So what we are proposing is that we would like to move all cell and gene therapies to excluded on our medical benefit to give us a tighter control and review process for these particular high-cost medications. I'd be glad to answer any specific questions on that, but that is the proposal and why we are attempting to make this move at this time.
So no members for any of the, therapies are currently impacted.
Correct.
And there's a pathway to appeal it if, you're wanting to take advantage of it.
Correct. And right now that pathway is a little gray. We are making it very black and white, what we want with our third-party administrator, how we want this review and approval process to go.
Are there questions?
Susanna Marshall.
Commissioner Marshall?
Thank you, sir. Grant, real quick. So Chair Hudson actually asked my question that we don't have anybody impacted, but is this list of, is this 2030? Is that the entire catalog of cell and gene therapies that exist? Or are these just the ones we're excluding?
This is an exhaustive list of those that exist as of the Friday before last Tuesday. So what that April 29th is, somewhere in the end of April. So we waited as long to develop the list to make sure we did have that comprehensive list.
Great. Okay, thank you. I just was trying to make sure there wasn't some that we were keeping.
Right.
And a difference of these. So thank you very much for that.
No, thank you for that question. Yes.
Any other questions? If not, take a motion to approve the cell and gene therapy policy. Got a motion? Second? Second, all those in favor say aye. Aye. All
Aye.
those opposed, no. The policy is approved. Next to the EBRX contract.
All right. This is the 1 year. It's time for the 1 year extension of this particular agreement with UAMS. This is the EBRX program that helps advise us on our pharmacy benefit management, formulary design, and those things. Be glad to answer any questions.
What year of the contract are we in at this?
4.
Any questions? Hearing none, take a motion to approve the EBRX contract.
So
Motions
moved.
are second. And let's take that as a second. All those in favor say aye. Aye. All those opposed, no. The contract is approved. And with that, the proposed rulemaking.
All right, so this proposed rule is in response to Act 956 of 2025. This act requires the Employee Benefits Division to have an independent vendor data validation process for any data that the legislature requests in response to fiscal impact. So these are the rules that are in place for us to do that work as we get ready for the next general session.
The proposed rule has been reviewed by the governor's office and signed off by them.
Yes, sir.
All right. Any questions? Hearing none, I'll take a motion to approve the proposed rule, which will allow it to go into the promulgation process.
Yes, sir.
Is there a motion? Got a motion? Is there a second? Got a second? All those in favor say aye. Aye. All those opposed, no. The proposed rule is approved for promulgation. Okay, to the medical rates.
Okay, so the first part of our medical rate development is you will see the overall rating for the populations, and then the next page chart, section of charts, will show the contributions going down to the individual employees. So you will see for the state employee plan, there is a 9.8% increase in the rate from 2026 to 2027 plan year. That does correlate down to a shared 9.8% contribution increase to the employee. And those are for the active and pre-65. For the post-65, the rates vary from a 6% increase up to a 9.2% increase. And again, you will see on the contribution that is shared down to the retired member. I'd be glad to answer any questions on the state employee plan.
What's the primary driver on the increase?
Utilization increases in the medical CPI and pharmacy inflation. So
Mr. Chair, I have a quick question.
we have held rates flat over the last 3 years as we were working on a leveling out between the state and the employee. We have reached that. So this is the reset of that activity and the shared increase of medical pharmacy CPI between the employee and the employer.
Commissioner Marshall?
I was just, that was exactly what I was going to ask Grant. If memory served, we had no rate increases for active, at least in the last year or two. So that's a correct statement?
Yes, ma'am.
Okay, great. Thank you.
The employer component.
The employer.
Go up though. Other questions?
Okay. Going on to the PSE rate development for active and pre-65, you'll see there's a 4.9% increase year over year for the public school employees, which correlates down to that 4.9% increase for the employees. On the post-65 population, that ranges from 5% to 9.7%, which also flows to the post-65 contributors as well. I'd be glad to answer any questions on the public school side. They have been flat for the last 3 years, yes. I would anticipate some sort of increase year over year just with the known increases that we're experiencing in this economy. Plus, it would be irresponsible to not do some sort of transparent, targeted chipping away so that we don't fall behind on our reserves.
Not only reserves, but I think also just to the extent that we are increasing a nominal amount year to year, it mitigates the hard swings all at once. So I think always moving it just a little bit so we don't have to move it all a lot in 1 year.
Yes, sir.
Let me just encourage you, if you didn't get a chance to look at, and I'm not sure if you're going to go through some of the.
I was not, but please do.
Okay. So for state employees, the appendix that has some of the kind of chronic condition information about state employees, if you look at slide 16, it's a very sad slide, I would say, looking at the chronic condition prevalence for state employees. This is relative to a benchmark, and then the benchmark is the South, which already has a high prevalence of chronic disease. So for example, the rate of hypertension for state employees, we have 12,000 incidents of hypertension compared to the benchmark of 7,800. Not quite double, but a big number. Diabetes, 5,000 employees with diabetes compared to 3,300 as a benchmark. So we do have a state employee population that is generally experiencing higher rates of chronic illnesses compared to other people just out in the community in the southern United States. That, for a whole host of reasons, that's something we should be looking at and considering. What can we do to help our employees be healthier? It's the kind thing to do, but it also affects directly how much we're paying for medical insurance for our state workforce.
So on that, in the past legislative session, you may or may not be aware, the health employee program, A-HELP, that was managed out of the Department of Health did get moved over to the Department of Shared Administrative Services, and it has now been put underneath the Employee Benefits Division. So I am going through a comprehensive analysis and study of programs all across the country, both public and private sector, to be able to see what we can develop to address exactly what you're pointing out.
So specifically, in the Rural Health Transformation Program, which DFA is administering for the state, chronic disease management is an area of focus for us. And, we're going to fund lots of initiatives that will help us monitor or help patients better monitor, their compliance with their treatment for their chronic diseases. So I'd love to see us, be thinking about strategies that we can follow as well.
Yes, sir.
Any questions? Got one more for you, Grant. On slide 13, in terms of our state employee and the asset projections for our reserves, net of IBNR, we're forecasting a decline in our reserves over the course of the next few years, and that's not a surprise. We knew that was going to be the case. Do we have any information from the actuaries that would suggest what a targeted percentage should be?
Let me go back and get that. I have generally wanted to stay, 20, 25%. I know the legislation targets us about 14, 16, respective of each program. I'm not really comfortable with going that low. I think that results in like maybe 2 or 3 months worth of reserves. I would really like to get us to about half a year worth of reserves. But I will definitely go back and have them kind of give us more of an analysis of what other states are doing in that space. And the charts that you do have, those are reflective as if these rates have not been approved. Once these rates that are before you have been approved, those will get redone to show the impact of that change. Those charts were made prior to the rate development and us settling on what we wanted to propose.
And our IBNR number, is it 90 or 120 days? How many days is our IBNR number?
It should be 180 is what, because you've got 6 months to be able to flow through the claim payment. So it should be around 180.
Any questions? If there are no questions, I'll take a motion to approve both the state employee and the public school employee medical rates for next year. Have a motion? Got a motion. Is there a second? Second. All those in favor say aye. Aye. All those opposed, no.
And Mr. Chairman, one more thing.
Yeah, go ahead.
Just want to plant a seed. The Employee Benefits Division and Office of Property Risk are reviewing and finalizing quite a few contracts. Due to procurement timelines and those things, we didn't have them ready for this meeting. We will need to do a special meeting before the end of May so that we can hit the June ALC review. There are a few, especially on the property risk side, that have a July 1 start date. So we need to make sure we hit those deadlines. I just wanted to plant that seed that please look for a special meeting to be coming by the end of this month.
Yeah, the portal would be the last week of May,
Right.
I think. So talking probably next week or?
Probably the last week of May, right after Memorial Day. Hate to do that, but we got one big contract that I would like to get through discussions and bring before you all.
Okay. Is that it, Grant, for your stuff? Okay. All right. Any other business to come before the board? Oh, real quickly, just as a reminder, I know we've been kind of roving around a little bit, but our meetings going forward will be in here. So you can always plan to come to this building for the quarterly meetings. And with that, we'll be adjourned. Thank y'all for your attendance.